Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna, CIO of Old Farm Partners. Our goal is to bring you great investors and the themes they're working on. Some are under the radar, and we think they're all experts in their discipline. Today, I'm excited to have a discussion with Genna Lozovsky of Sandglass Capital. They have emerged as one of the leading emerging market credit investing firms in the world. They run about $650 million and are based in London and New York. And I think by mid-year, they're going to be about $1 billion. I think this is going to be great. Genna has lived and breathed EM for a long time. He's an American who was born in the Soviet Union, and we're going to go through the state of emerging markets. Genna, welcome.
Thank you so much, Kieran. Thank you for hosting me.
Great. Well, I'm excited to do this. A lot going on in your world. So I just thought we could kick off a little bit on just your background and how you got to this point. That'd be great to hear your bio and then how you started your business.
So my background is, as you said, I was born in the former Soviet Union. I was born in Kiev, in Ukraine, and my family made a decision that they wanted me to grow up. They wanted to spend the rest of their lives in the United States and wanted their children to grow up in the United States. So we left when I was a 3-year-old boy, and we started life in Dallas, Texas. Eventually made our way to Seattle, Washington, where I spent most of my childhood. And in the middle of it, my father was working in Malaysia, so we had a chance to. I spent 3.5 years in Malaysia as an adolescent as well. And so maybe in somewhere in all that story, some sort of passion for EM was born at an early age. But then after university, I started my career in New York at Credit Suisse, and was recruited to be part of this very early, exciting effort for Credit Suisse in Moscow. In the 90s, based on just a fluke that I happened to speak Russian. And I joined the CS team. And then shortly after arriving in Moscow, I teamed up with the team from that was leaving Credit Suisse to form a firm called Renaissance Capital. And at Renaissance, I spent a big chunk of my career basically doing private equity in the former Soviet Union, in Russia, Ukraine, Kazakhstan, technically Belarus, we look at things in Georgia and other places. And fast forward a little bit, in 2008, as Lehman was closing down and the global financial crisis was kicking off, me and some colleagues that I'd met through work decided not to let an amazing opportunity go to waste. And we decided to start a firm called Thematic Capital Management, which was seeded by a large multi-strat hedge fund. And we started a firm called Sandglass Capital Management, which was a global special situations fund. And my job was just the kind of EM sleeve of that. And in 2012, my colleagues wanted to go back to their former employer. And for me, that was a sort of a wake-up call to maybe do something on my own. And hence, some years later, in 2013, we launched Sandglass. And some years later, here we are. So that's a few words.
Well, that covers a lot of geography, a lot of history, and a lot of continents. So very cool. One of the things I have to admit, as an allocator, I have just not been paying attention to what's going on in EM credit, and it's been incredible. And I think we mostly have been focused on U.S. tech, and I think you can understand why. But I mean, I would stack up your returns to any TMT manager over the last 5 years, and my bet's you've done better. It's a little flattery in there, but also, can you just tell us what's been going on in EM credit? I mean, you do a lot of countries. You don't do China.
No, the truth.
But maybe you could just give us a sense of what's been going on there and why the returns have been so good.
Sure. So I think the underlying thesis of the fund of Sandglass has been to always try to identify those pockets of emerging markets that have the kind of idiosyncratic convexity and asymmetric profile of returns that made early EM investors feel so rewarded, frankly. And I think much of the sort of general story in EM, when most people think about EM, they typically think about equities, which of course were fantastic in the period from up until the global financial crisis. And then ever since then have been frankly, returns there have been sluggish. And for reasons that you've just articulated, the U.S. has been a huge vacuum cleaner, if you will, for global capital, and has led to spectacular returns in the S&Ps. I think EM credit along the way has benefited from what has continued to be, notwithstanding sluggish equity returns in EM, frankly, very robust macroeconomic numbers. I mean, EMs keep promising you the same story, which is for a fraction of the debt, levels offer you 150, 200 basis points in excess real growth. And that story has remained robust all through the last 15 years. So I think EM credit, I think credit is a more, as I say, almost a purist and less sentiment-driven, if you will, expression of that overall benign backdrop. I think specifically in the last 5 years, EM, and not just EM, but credit in general, has experienced a couple shocks. Shock number one, of course, has been the pandemic. And the second shock has been the 2022 very sharp spike in U.S. rates as a result of the reemergence of inflation globally. Now, for me, who's been a longtime EM investor, anytime I would see U.S. monetary policy tighten up so rapidly and so sharply, I would have almost always expected a domino of EM defaults globally as a result of that. And of course, we know that didn't happen. Something's traded as if it was about to happen, but it frankly didn't happen. And in fact, in 22, we had 3 EM defaults. We had Sri Lanka, we had Ghana, and we had Ukraine. I think Ukraine, you'd argue, would probably default no matter what. But so I think kind of for those of us who remember 1997, 1998, this is, of course, a very paltry default scorecard. So what we've seen ever since 2022 has been a very sharp adjustment by EMs to address imbalances as a result of this tighter money supply, and of course strong support by IFIs and other internationals like the IMF, but not just the IMF. By the IMF and China and even Saudi has emerged as a supportive lender to certain emerging markets, and so that kind of cocktail of willingness to make adjustment and financial resources to smooth over certain defaults has resulted in asset prices recovering very sharply from the fear kind of about to default levels to trading much more on a yield or on a spread basis, if you will, to treasury. So I think those are. I think maybe I summarized it by saying that some of the panics that we've seen in EM asset prices over the last couple of years have proven over the last 2 periods have proven unfounded, and as a result of important cyclical and structural factors, we've seen very sharp rebound in asset prices. And again, I think the EM credit story remains as interesting, as robust as ever.
Yeah, actually, I'd love to get into that a little bit on a go forward, because clearly the returns have done great. Credit spreads are relatively tight everywhere around the world, but my sense is that 20 years of looking at EM credit myself, you would go through cycles, and the risks were higher in the past, and they just haven't bubbled up here for a variety of reasons. I mean, we're going to get into individual countries. I also think that countries have generally been a little smarter on, not smarter, but necessarily, that they just don't have the debt levels they have. Maybe they have less dollar debt, and they didn't inflate their way out of the pandemic, right? I mean, they couldn't because they didn't have a reserve currency. So, go ahead.
Yeah, I say all those things are true. The kind of fiscal bazooka that we saw in Europe and the U.S. or in developed markets during COVID, EMs don't have bazookas like that. And I would say secondarily, of course, just with the passage of time, the increasing capital accumulation of EMs over the last 25, 30 years has resulted in a larger domestic savings base, which is a natural source of financing, if you will, to home market. So that's kind of, in a certain way, you can think about it as they continue to de-lever, if you will, from the dollar. And while remaining levered, while not remaining excessively levered in their own right.
So where are we today? I mean, why is it a great time to do this? And love to hear kind of the best areas you think investors should be looking at.
Sure. So I think what you've seen is this story of policy normalization and adjustment has been pretty pronounced. I wouldn't say that it's over. And after such sharp moves, there remain almost always remain interesting pockets of additional incremental value. And we're seeing that already. So maybe I just start in some of the defaulted and restructured names. I mentioned Sri Lanka and Ghana as two of them. Both have successfully completed their restructurings last year in 2024. And anyone who's ever been through a EM sovereign default knows that once the sovereign balance sheet's cured, there are still many areas that still where prices and frankly situations are still dislocated. So we've done, I think, a pretty decent job of finding those and putting capital to work. And we remain active on restructuring committees and groups to help support the reemergence of some of these credits to performing status again and to cure them from their defaults. So I think that's one aspect that remains interesting. I think secondly, I think this process of policy adjustment still has room to run. Obviously, the big turnaround story for the last 18 months, especially for those involved in EM credit, would have to be Argentina, unquestionably. A country that's had a troubled relationship with credit markets for the last 20 years. And you have a new administration that has done quite a, I think, successful U-turn in trying to rebuild and reestablish that credibility with markets. And I think, investors that have bought into that thesis have been very handsomely rewarded. As you know, Argentina sovereign debt prices rallied over 100% last year. So I think that story is still not complete. A country like Argentina, today trades 300 basis points wide to single B creditor, single B rated fellow sovereigns, and looking harder and harder to justify that. And I think there remains a few policy steps that Argentina needs to take in order to complete that process. But I think those they look very, very likely, I would say, and I think it's a very attractive bet.
Hey, again, I would love a quick tangent on that. Just as an investor looking at what it's an extreme thing. I'm fascinated with what they've been able to do. Do you think they'll be successful? I mean, what are your odds you think they'll be successful that Argentina reverts back to its status? I mean, I remember 100 years ago, it was on par GDP-wise with the United States. Obviously, they're about 50 times smaller. But what do you think of the chance of them actually getting on a sustainable growth path?
Well, to get on a sustainable growth path is not necessarily what we're looking for as creditors. We're looking for them to get on a sustainable path. And I think it will involve, of course, a growth path. But the growth part is a bit of a luxury, certainly for credit investors. I would say the dynamics in Argentina, or the political dynamics in Argentina, which are, of course, probably the guiding light here, look overall favorable. And we'll have a chance to test that this November at the upcoming midterm elections. Certainly polling, to the extent you want to trust polling in Latin countries, it looks quite favorable. I think some things from this Milei administration, I think, will have long-lasting ripple effects on kind of the political economy and the political psychology in Argentina. That's a big turnaround. So I'd say the two for me that are most obvious would have to be monetary financing of deficits looks like it will be a thing of the past for a while. I mean, nothing's permanent, but it looks like that's going to be forgotten for a while. Secondly, I would say this idea that default is a political victory, I think, has been just completely shamed and disproven. I just have to look at the province of Buenos Aires, where, Milei's likely political competitor in the upcoming president, or a likely competitor in the upcoming presidential elections in 2.5 years, sits as governor, and he's made tremendous fiscal adjustment. I remember a year ago, I would say some skeptics were claiming that the province of Buenos Aires would default as a way of kind of drawing a sharp dividing line between the province and the federal government, and to set the battleground, if you will, among the public. And we've seen none of that. Right. And if anything, I think, the other way around, I think the province is doing everything they can to assuage investors. So I think a couple of things I think will stick in Argentina, no matter how Milei personally fares.
No, it's super interesting. Do you think that, last quick thing on Argentina, that just getting on that sustainable path seems to be, I mean, that is what they need to do to enter back into the global kind of system. And it seems the Trump administration relatively, they see, I know Milei was there on inauguration night, right? So
he was there for the inauguration.
Yeah. I mean, so is that a priority, you think, for the United States to help them get back on their feet, or is it just, you think this is independent?
I struggle to ascribe priorities to the current administration and to know what they're thinking. I'm sometimes a little bit confused as to what they're trying to solve for. That said, I think the personal relationship between Trump and Milei, which clearly features prominently in U.S. policy at the moment, is I think a very strong one, and one that would help Argentina, especially when it comes to what's now on the table, which is an IMF program, and potentially future trade relationships between Argentina and the United States. So I think overall, I think that we're kind of in a good period at the moment for Argentina. The challenge that the country has in the near term is addressing FX policy, and I think some of that will be addressed prior to the election November, but the balance will be addressed almost certainly after the November midterms.
Well, I know you made a lot of money in Argentina, but you've done well in Ukraine, and I would love for you to talk about that through the lens as a credit investor. Obviously, it's in many levels to that situation, but what do you think where are we on what you're seeing from an investment standpoint?
Sure. Generally, we have when the war started in February 22, we were probably, like everyone, a little bit shell-shocked to try to digest what this would mean, not just for Ukraine, but more broadly. And it was clear that the prior administration, the Biden administration, was trying to preserve as much as possible the old security architecture in the face of this new challenge. I think the new administration in the U.S. is trying to reshape that security architecture, and the jury's out how successful that will be and what the implications of that will be. That said, what we saw quite early on is, in the hopes of preserving the security architecture, we saw very strong support from Ukraine's international partners at that stage, the U.S., the Europeans, and of course, and far beyond. And after some months, I think it became evident that the sort of maximalist goals of the Russian Federation in Ukraine were unlikely to be accomplished. And so, at some point, you had this understanding that Ukraine as a polity would survive, as an independent country would survive. How sovereign it would be still remains, that jury's still out, but as an independent nation, it would survive. And the second part you saw was that there was tremendous economic support to dampen the obvious collapse in economic activity. And so what was interesting is, looking several months into the war, even in 2022, there hadn't been a single Ukrainian corporate that had defaulted. I found that shocking. And many of them, as you would expect, quickly adapted businesses to the current situation. Agricultural companies who were typically using the Black Sea export product started relying on rail. And that same thing became true of the steel industry, the ore industry, et cetera. And so at some level, I remember looking at in early 23, looking at financial statements being reported for 2022 by some of these companies. And if you didn't know better, you wouldn't necessarily know that there was a war on just by looking at the financial statements. I thought that was interesting. In late 22, we made a decision that the stars are aligning, that, credit is super cheap, and as sooner or later we get a ceasefire. But until we do, these issuers will continue to remain current on their debts, and they're strongly incentivized to. And corporate credit was trading at the time at, pick your poison of your issuer, but 20, 25 cents, and remaining current on, at coupon rates of 7, 8, 9%. So you didn't need much. As long as they remained current for a little bit, you ended up doing okay. And of course, as the story continues, by late 23, almost all those corporate issuers were trading 3 times higher. And that was for us a natural rotation out of corporate credit to find other ideas in Ukraine that had those same characteristics. We found that in state-owned corporations, and they from 23 to 24 went through that same period, if you will, of the market appreciating their willingness to remain current on their debts. And now I think the last remaining question is just simply if and when there'll be a ceasefire. I think that is the last remaining question. I think the jury's out. My personal opinion is that the momentum for a ceasefire is extremely strong from all sides, both the Russians and the Ukrainians.
Well, hopefully by the time this airs, there is a ceasefire. Yeah, it's been amazing to watch, and that fact that they've kept their financial system together is really amazing. What about the Trump administration overall for what you do? I mean, you touch lots of countries, right, and and a lot of continents, but and that obviously the word of the day is tariffs. How is it affecting your opportunity set?
I think it's premature a little bit to say. There's a promised nation by nation tariff announcement April 2nd, so I think. Look, overall, EMs are typically, and not exclusively, or the EMs that we're involved in, are typically, although of course not exclusively, exporters of goods that are on the lower end of the value chain. And typically they form critical inputs, if you will. And although we've already seen some threats of those being tariffed, I think that isn't quite the story that this administration's targeting. Although, as I said again, I'm not 100% sure what they're solving for. So I think that in terms of how some of our economies will be affected when we're invested in at the moment, I'm not quite yet in a place to say definitively that tariff policy will necessarily hurt us or actually even potentially help us. The jury is out of that. I mean, for now, most of the guns seem to be trained on Canada, Mexico, and the EU, kind of our larger trading partners, and of course, and then the important gorilla, of course, is China, of course. So I think the U.S. risks trade happening around the U.S. I think the model of tariffing higher value added goods coming into the U.S. has, for me as a former student at the University of Chicago, I have to say feels very bad economics, mildly put, and it's typically inflationary, growth negative, profit negative. I think it's a dark road. I think it's a road to nowhere. And I think that this tariff policy may survive the Trump administration. I don't think it's survived much longer. And the risk is, of course, that EMs and the rest of the world just eventually trade flows happen over there in the way that they're more accustomed to.
Well, what about trade policy then beyond tariff policy? Because it seems to me the intent isn't necessarily use tariffs. It's more of a tool to get to a place, conditions that they want, where they want U.S. manufacturing to increase, where they want goods made here that are high value, as you say. I mean, do you think that it will certainly cause a lot of disruption, and I would imagine there will be pretty decent sized winners and losers.
Well, Kieran, my first question has to be: I'm hoping the United States isn't Gosplan, right? Gosplan was the Soviet central planning system. So I'm not sure why a couple hundred people in Washington should decide if the U.S. should be more manufacturing rather than services, and why that's necessarily a win. I tend to think that market forces can do a better job of filling out where capital should be allocated than than that. So that would be my first. And that just takes me back to, typically when you run against the market, you may think that there's some reasons for that. And that's fine, but it's typically growth negative, inflationary, and otherwise. And so that's the price you have to pay to get to that endpoint, if you will. The U.S. has been a huge victor in the last 20 years from free trade. I think a lot of that keeps getting ignored, and we keep looking at some of the places where we've lost, ignoring all the 100 other places where we've won. And I think that needs to be factored in. So that's one part of my answer. The second part of my answer is I want to just go back. I'm a little bit confused as to what they're solving for. On the one hand, I hear about tariffs being used as a source to trigger reciprocity, meaning to reduce tariffs overall, both from our trading partner and in the United States. But that seems to run counter to the other narrative, which is that tariffs are going to be a big source of revenue for the federal government to fill our coffers and will finance income tax cuts. So they're either permanent or they're not. And it's important to remember that the income tax in the United States was introduced by constitutional amendment as a way to replace tariffs as a source of revenue for the federal government. It does seem like we're doing quite a century-old U-turn.
Yeah, it is. It's a great point about what's been right the last 20 years. I think that I don't hear that very much. I'd love actually maybe to go off script a little bit and ask you about, what I'm detecting. There are some great growth stories that are independent of kind of all this U.S. China stuff going on, where you focus on a lot of different countries. I would love to. Are there any great growth stories you're seeing that are just good policy leading to good growth, and as a credit investor, you're able to capitalize in EM right now?
Typically, I think, we've mentioned Argentina as potentially a very good growth story. For us, I think the growth story in certain pockets of Africa is definitely very interesting. And again, us as a credit investor, we typically don't benefit too much from that. But what's interesting is, and I just want to kind of add that in the 21st century restructuring technology that's been created, which is to avoid long drawn out negotiations between creditors and debtors, and instead introduce contingent instruments, which lets payment flows or cash flows be predicated on future outcomes rather than trying to pre-agree with those in advance. We have a greater and greater number of contingent instruments trading in the market. And for us as a hedge fund, as an investor, not uncommon to find cheap volatility being offered in the market, certainly by traditional real money accounts. And so without kind of giving away too much, I'd just say that I think that there's a few really great ideas out there where I think optionality on attractive growth can lead to just tremendous payouts that look, far superior than even equity returns, than what you'd expect from equity returns, in the event that some of these growth stories play out. There's pockets in Africa you have to point to for that, pockets in Latin America as well, frankly, and even in Eastern Europe.
Yeah, it's very cool. I mean, I think we're about the same age, and we've seen a lot of EM crises over the years. In fact, it's been a long time since we've had one, and nor does it look like the conditions are there for one. Don't you think? I mean, something in the system has changed a little bit.
I don't see it. If anything, the great EM kind of kickoff, probably the ideal conditions for EM would be a US slowdown. Like if I think about the four quadrants, I would say the optimal outcome for EM would have to be a US slowdown, and with U.S. rates coming down, but not so much so that it breaks the EM kind of growth trajectory. That would kind of be like an ideal kind of a soft landing in the U.S., which could allow EMs to really explode on cheap cheap financing. And I'd say probably the other quadrant, the really dark one, would have to be stagflation, of course, in the U.S. Would be dark for everybody, I think. But I think a stagflationary outcome would be the one that would be, of course, bad for credit investors and equity investors globally. So what we've tried to do is find, and I think we're benefiting from that, is find assets that have done well or that can do well in a U.S. slowdown. And fortunately, EM is, way past just being a long commodity story. We have many ideas in EM where, we're short commodities, basically. And I would say some of the challenges, for example, in the airline sector and pockets of EM, especially in Latin America, is perhaps maybe an ideal spot for that, where a weaker dollar and cheaper oil, and hence cheaper jet fuel, can lead to much stronger P&Ls and balance sheets, if you will, for some of these airlines that are kind of struggling. And if you believe that that story can take root, you can get very attractive convexity, both in both in credits and in equities.
I mean, one of the things I love about credit investors is that you're thinking, how do I lose? Right? That's the first question usually. And but it's an order of complexity higher, I think, than like if you were looking at United Airlines, you're very balance sheet driven. You're looking at the income statement. I mean, you're looking at Latin American airlines and doing this analysis, you'd have to incorporate so many other things. I mean, right? Am I accurate, or is it more of is it just the same credit underwriting that you would do in the U.S.?
Well, first of all, I would just say that if I just contrast EM credit to EM equities for a minute before I answer your question, which is contrast developed market credit to EM credit. I think the important thing at EM credit, and why I think we've done okay, is of course, in EM equities, you find something that's attractive, cheap, and you love it. But until everyone else agrees with you, it kind of sits there and does nothing. And credit, of course, is a little bit more purist. And it has a natural day of reckoning, if you will. They pay or they don't. And I think that from my point of view, that's very helpful. Now, in terms of comparing, as you say, like United Airlines to some LATAM airlines, I think I would agree that there's unquestionably a top-down dimension that's more specious to some of these EM credits that you may not see necessarily in the U.S. That top-down dimension cuts two ways. We've seen, whereas you have the political risk factors in EM, but you also have tremendous moral hazard in EM, and frankly, moral hazard meaning moral hazard support for issuers as a result of industrial policy that, again, I as a Chicago economist may not necessarily agree with, but does form the base of the political economies in many of these countries. And so I think that's a factor, too, that shouldn't be ignored as well. And unquestionably, we have to weigh what are the political economic consequences. So, for example, we typically, when we do corporates, when we do EM corporates, which is a big part of our business, most of these issuers are not, a mom and pop dry cleaning chain in Sao Paulo. These are typically mainstream, companies that form the backbone, if you will, of many of these countries, and their failures have ripple effects and repercussions. And in this respect, EMs are probably no different than DMs. Our societies don't like, dealing with failure, dealing with failure and the after effects that come from that, which is why we've had so many bailouts in the United States and we've had so many bailouts in Europe. And in that respect, of course, EM is no different.
Yeah. I mean, I wonder if I know you engage with borrowers directly at times.
Yes.
Right? Yeah. Use your balance sheet and you have a substantial capital to your advantage. Has that changed? Has that improved in your career in that these guys are sophisticated guys. They often went to the same school as we did. And it's just a much more traditional credit experience that in EM as it is in DM.
It's definitely become a lot more traditional, unquestionably. And if I just divide that world a little bit between corporates and sovereigns, in corporates, it's become a lot more traditional. We, of course, typically deal with, as I just said, some of the larger corporates in credits that are typically issued under New York or UK law, which already kind of migrates the professional level to those with experience in handling restructurings in those kinds of jurisdictions. In sovereigns, I think the main change that's happened, and it's a very important one, is there's been, although we don't have a global chapter 11 for sovereigns, there's certainly more and more efforts to create one, or at least kind of protocols or understandings of how to address sovereign restructurings. And the IMF has played a instrumental role in that, whether there's a lot of criticism of how they've done it, but the direction of travel, if you will, is to create protocols and understandings of how to address sovereign restructurings in an orderly way. And what's already happened and what we've seen is that as a result of that, the volatility from outcomes has dampened quite a bit. Frankly, I would say a little bit to us, to our disadvantage, if you'll forgive me. But what it means is that post default, investors very quickly can price that this country is going to have to make these adjustments. The IMF's going to come in. We know the range that IMF is going to want for debt sustainability here, and then people start pricing bonds quite quickly around that potential framework. And those frameworks have been promulgated and well defined. So it's quite trivial to do that math.
It's interesting, right? I mean, definitely some risk premiums come out in a good way too, right? Because it's less risky of an asset class. And
100%. It's become a lot less risky of an asset class. As I said, a little bit to our disadvantage. It means that maybe I'll give you an example. When Ghana defaulted, I think the lowest print in bonds on the day of default was like 35 cents. Okay. And ultimate recovery was in the high 50s about 18 months later. And in the EM that people remember in I would say the 90s, early 2000s, that first print would have been at 5-10 cents, right? And the reason why we didn't fall so much, again, as I say, is people quickly understood this is a country that has some reserves. The IMF's going to come in, provide them some financing. We know where debt's going to shake out roughly within these parameters, and so no one's going to give you bonds that cheaply.
Right. I mean, and you see the outcomes of countries that didn't play ball, right? Like Venezuela and others, where you become very isolated.
That's true. But then you also see countries like Lebanon, who today, after spending now almost 5 years in default, and with some important political changes, especially in the security situation, have now formed a government and are trying to get an IMF program.
Wow, very cool. Let's hope. I guess just riffing on that again. I mean, I saw your recent outlook. You said that you thought further repricing in the EM would occur. I mean, why do you think so? I mean, it's come a long way.
Well, I mean, I think I want to kind of divide the world a little bit between the kind of B or better credits and the kind of B and worse credits. So I think the B or better credits, I think the jury's out on this question, whether credit spreads can tighten further. I would say they aren't exactly wide at the moment. I would say a U.S. recession would almost certainly widen them out as a first stop. Although I think eventually the hunt for yield would solve that question. I think in the B or worse category, I still think it's quite a good hunting ground for opportunities. And if you see where B or worse trade, they trade at historical wides to performing credits. So in other words, investors today are happy to take performing EM credit and earn relatively modest spreads, but they remain very, very unwilling to own EM assets during the risky period until they become so performing. And that creates an opportunity.
Yeah, the conditions are very interesting for EM, isn't it? Especially with all the Trump stuff going on, and because more importantly, the dollar, right? Because for so many years it was hinged. Are we still in a state where most EMs are hinged to the dollar directly or indirectly?
I would say the answer, of course, is yes, just less so than before for the reasons we discussed. I think like 22 was the dollar day of reckoning, if you will, right? And as I said, I think most EMs survived, although with a little help from their friends. And so I think the answer is unquestionably yes, although much less so than, for example, 97, 98, 99, where again, it's also, let's not forget, very few are running currency pegs anymore, as we saw. Remember, for those who remember 97, 98, EMs were running down their reserves like crazy to try to defend overvalued exchange rates in with the peg. Now today you have much more flexible exchange rates, and that of course means that you can have output doesn't have to take the full hit. Price can take some of the hit as well.
We also live in a multipolar world for the first, or something going on, because I know you don't do China, but clearly China has a huge effect on what you do. So maybe you can talk. Yeah, what are you seeing in terms of what China has been doing and how it affects what you're doing?
Well, I think in the world of global finance, China has obviously decided to not let the U.S. Be the sole provider of soft power financing. I'll put it this way. China then learned in 2022, in 2020 through 22, I should say, through a range of defaults, that this financing is not necessarily money good, and it took them a couple of years to realize that to get their heads around that they have to sit through a restructuring process like many others, and I think that experience where we've seen in so many sovereigns, China acting as a dominant or a very active lender has unquestionably bound them much more to China, but at the same time, changed the way and frankly delayed many of these restructurings. Probably kind of, I think probably China's graduated to university with stage on this question. But I think that, your question of multipolarity is an important one. In a bipolar world like we had during the Cold War, that's a certain stability and that's a certain equilibrium. In the unipolar world that we had for the 30 years after that, that's a new equilibrium. And today, I'm not even sure that we're entering a bipolar world. I think we're entering a multipolar world. And I think as the U.S. continues to, I think, quite willingly ceding space, if you will, that space will get filled up. And we see it economically, we see it politically, not just by China. In smaller way, we see it in the Middle East by Turkey, which is emerging, I should say, as an increasingly important voice in the Middle East and also in the Turkic world, in Kazakhstan and Uzbekistan. So I think that you will start seeing new poles, if you will, of power being formed as the U.S. slowly kind of retrenches. And, this story, if I think about the history of our great nation, it keeps going through the cycles of engagement and isolationism, protectionism and free trade, open immigration, closed immigration, and we're just going through one more cycle at the moment.
It looks like it. But one thing that's very interesting, since you mentioned it that way, is that our corporates in the United States are as dominant overseas as they are here. I mean, Apple and Google and things like that. And they're dominant in many of the countries that you invest in and often displace local media in some of those cases, right? And technology. Is that something that could change at some point, or is that very, very dominant? I know that you're more of a credit investor, but what you see in, you look at a lot of these domestic economies that we don't. I have to look up Ghana, which continent it is, for instance.
It seems like the free reign of tech is going to I think the free reign of tech is going to increasingly meet geographical barriers, regulations, and otherwise. And I think that will almost certainly clip its wings a little bit. I think long term, the trend will remain unchanged, but I can imagine that for a while, you will start seeing more and more obstacles, if you will, for free tech. As an example, by the way, the Russians got rid of almost all American tech within a couple of years. And in China, frankly, as you know, many of the household names in tech are almost inaccessible. And nothing says that can't be repeated in other places. In China and Russia, that happens for political reasons, political and economic reasons in China, political reasons mostly in Russia, but it could happen for economic reasons in other places, not necessarily for political ones. People are finding ways to be protectionist too.
I mean, I'm sure you're looking at this too. Not only is on Ukraine, we get a peace deal. It is clear that if there is a peace deal, that Trump administration is keen on bringing Russia back to the global, and to what extent we don't know yet. That could be very interesting for you.
Yeah, I think this administration clearly. Let me just say the jury's still out. I think that one take on the administration's posture is that they are looking for, they're dangling carrots in front of the Russians as a way to entice them into a ceasefire. A different perspective is that they want to re-engage with Russia almost no matter what. And that will happen rather quickly. I'm skeptical that the U.S. companies will become active investors in Russia, even almost no matter what the Trump administration says. For the simple fact that way before the war, there was almost no U.S. outside of the oil sector. There was almost no investment. There was almost no American investment in the Russian Federation, and notwithstanding the desires of the administration, there's nothing I've seen in the last 3 years that would suggest that anything the administration says will override the last 3 years of considerations. So Marty is a skeptic on that question. But probably a different one is, which is could we imagine Russia tapping bond markets in the next 12, 18, 24 months after a ceasefire? And I think the answer has to be yes.
Wow. Yeah. And then it gets even more multipolar. And for that years of that, as you called it, the golden age for EM equities, the BRICS, right? And, but clearly the BRICS have all had very differing paths. Like South Africa is really almost, well, actually maybe South Africa, you talk about that because I have great South African clients who are very proud to be South African. But what I read in the newspaper, they're like, don't believe it all because it's a great country. And what's your take on South Africa doing a U-turn of their own here? Because they've had a lot of problems.
We haven't done much in South Africa, and we struggle to find opportunities there. I'll be honest with you. We've done a little bit of credit in prior days. Generally, I found a hard market for us. I find that the kind of the broader macro themes in South Africa generally point downward. I appreciate that the current administration is trying to pivot away from that. For credit, we've just really struggled to find interesting ideas there. We don't do much local currency. As you know, we're mostly a hard currency shop. And so in a hard currency, we've really not found much to do there. So I would have to plead ignorance on this question.
Well, I know you've traded Greece. Maybe you could talk about Greece. It's a small country, but what do you think?
I mean, Greece has been one of the three kind of key pillars of P&L for our firm since its inception. I think Greece has been maybe the most remarkable success story of the last decade in terms of turning around its fortunes. Although through tremendous pain. We were early investors in Greece shortly after the Greek default in 2012. And as you know, that default was secured around the time of our firm's inception. And so we were very active investors in Greek government bonds when they were trading at 25, 30 cents. And we eventually pivoted from those once they rallied to kind of close to performing levels to bank debt, specifically bank sub debt, which was interesting for us. And then eventually, as that became sort of par instruments, we migrated towards some single name equities, specifically banks. And then as the banking sector normalized, which is kind of a proxy in the whole macro economy, of course, that was sort of our final hurrah, if you will, in Greece. I think the Greek story is phenomenal for several reasons. It's been number one, somehow politics held up, notwithstanding the fact that unemployment rate stuck at 25% for 4, 5, 6 years. I remind you that the Great Depression that has scarred Americans for several generations, we touched 25% for about a year, and we're still talking about it. And so somehow the Greeks survived that. In the middle of all that, when we in the U.S. faced that kind of depression, we went towards big government fiscal stimulus. Of course, the Greeks were forced to do the opposite, which is to retrench fiscal and make structural fiscal adjustment. And so you had this tremendous collapse in the price level because, of course, they don't have their own currency. And so I think for me, the interesting story in Greece is several things. Number one, that a society was able to accept this very sharp and painful adjustment, both to output and to prices, all at the same time, with very little kind of societal support for it. And then number two, it's hard for, I think, Americans to appreciate, but the allure of remaining in the European Union on the common currency can be the only prize for taking such pain. And the Greeks determined that it was that price was worth it. And I guess for those of us who remember how the drachma did when the Greeks had their own currency, maybe the Greeks are onto something. And it is worth accepting that pain to have the ability to save in a currency controlled by Brussels rather than by Athens.
Right. And we might have an emerging growth story coming in Europe, too, with German deficit spending, defense. Right. And they have a cheap currency. It's appreciating lately. But yeah, it's actually, you make a great point.
Absolutely. I would say, by the way, Greece has been the fastest growing economy in Europe for actually of OECD countries for the last several years. It's been truly an amazing turnaround story. And if I just add at a personal level, as you know, we still engage with Greek issuers, even though we have very little risk there. The level of professionalism in Greece I see today versus what I remember from 10 years ago, it's a whole different level. It's very impressive how when you set the pieces right and you set the rules right, how technocratic excellence and professionalism can bubble up to the top. And we've seen that in recent very much.
That's very cool. Well, Genna, I want to do one more question, then we could wrap up. You clearly have a lot of passion for your space, and it is really intellectually very interesting space. My sense is people are underallocated to EM, both credit and equity. at least U.S. allocators. What maybe you could go back to more of what you think the next 5 years, why it could be a great place to be allocated to.
Well, I think EMs are heterogeneous, diverse, and always different. And I think there's for an investor for an investor with a sufficiently global perspective and a strong level of deep engagement in local markets, which I just want to say, from our point of view, without local engagement, we don't do anything. I think it's critical in EM. But I think with that perspective, I think one can always find attractive opportunities and can find asymmetry and convexity in EM. So I think that's very attractive. I think number two, I think one always has to compare DM to EM as a space, certainly for an allocator. And I think unquestionably DM is very, very, very crowded. And as you've seen, certainly in credit, the advent of private credit has made that space even more crowded, which of course competes away returns. And in a certain way, Kieran, for the very reasons you've identified, that EM remains underallocated. As long as it's underallocated and it's not overallocated, it remains attractive. And maybe just throw up one number here as an example. We did this whole study where we compared valuation metrics, and this is for equities, but it sort of, sets the temperature, if you will. We compared valuation metrics for DM equities, all world, against emerging markets, all world, for the last 25 years. And interestingly, EM was the most expensive to DM in 2007. It was in the 99th percentile of valuation, meaning, so that was when EMs were super expensive to develop markets. And you know what happened? Everyone knows what happened after that. We had this very long period of very substandard returns. Fast forward to today, EMs today are in the first percentile, of valuation to DMs. So that's not a sufficient case to say go buy a lot of EM assets, but it's a pretty good place to start.
Yeah, absolutely. Well, Genna, you make a great case, and it's a very interesting area you're in, so I appreciate it. Thanks for doing this today.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and hosted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.